In 2008, a portfolio manager at a mid-sized pension fund in Chicago watched the S&P 500 lose 57% of its value over 14 months. He managed other people's retirement savings. He had done everything the textbook said, diversified across sectors, balanced between stocks and bonds, stayed the course. And by March 2009, the fund had lost nearly a third of its value anyway, $41 million. Gone. What shook him wasn't the loss. It was a conversation he had shortly after with a colleague who ran a much smaller fund and had actually made money during the same period. Not a little money. 11% positive returns while the broader market was being cut in half. Same market, same crash. Completely opposite outcomes. Here's what most investors believe. When markets fall, everyone takes the hit. You hunker down and wait it out and recover on the other side. That's the consensus. But that framing hides something important. Crashes don't just destroy wealth, they move it from one group to another. And the people on the receiving end aren't lucky. They're prepared differently. So what does prepared differently actually mean in practice? That's what this video is about. Because right now, in 2026, with markets navigating tariff escalations, persistent inflation, an active war in Ukraine, rising tensions across the Middle East, and a Federal Reserve that has already used most of its conventional tools, that question is not academic. It is immediate. If a serious downturn hits this year, and the conditions for one are more present than they've been in several years, the difference between understanding this mechanism and not understanding it will show up directly in your account balance, not through bad decisions, through an incomplete strategy you never knew was incomplete. My name is Alex, and if you've ever felt like your portfolio did everything right and still came up short during a rough year, stay with this, because the gap between losing and gaining in a down market comes down to one structural difference. And I'm going to show you exactly what that difference is and which specific assets have captured it repeatedly across the worst crashes in modern history. Once you understand how wealth actually moves during a crisis, you'll look at your own portfolio and immediately see what's missing. That structural difference becomes clearest when you see it play out between two people making nearly identical decisions and arriving at completely opposite places. Sometimes the most revealing thing isn't what happened. It's that two people were in the exact same situation and got completely different results. It's March 2022. The Federal Reserve has just launched the most aggressive interest rate hiking cycle in 4 decades. Inflation is sitting at 8.5%, the highest reading since 1981. The S&P 500 is starting to crack. And somewhere in Columbus, Ohio, 2 brothers are both opening their investment accounts on the same Sunday morning. The younger one is Marcus. He's 32, works as a senior operations manager at a logistics company, earns a solid income, and has spent the last 3 years doing exactly what every credible financial voice told him to do. $800 a month, automatically transferred into a broad S&P 500 index fund. No market timing. It's no second guessing, just steady, quiet discipline, month after month for 36 months. His total contribution, $28,800. He opens the app. His balance reads $24,100. He has lost $4,700. Not because he panicked, not because he made a reckless bet. He executed the standard playbook perfectly, and it still cost him. Think about what that moment actually feels like. You did the responsible thing. You automated it so emotion couldn't get in the way. You ignored every headline telling you to do something different. And after 3 years of discipline, your account is smaller than what you put in. That's not just disappointing. It quietly erodes something deeper. The belief that doing the right things consistently is enough. His older brother, Trevor, is 38. He's a high school history teacher with a genuine interest in how economic cycles repeat themselves. He's not a finance professional. He doesn't have access to anything Marcus doesn't. But their grandfather, a man who lived through the 1970s stagflation and never forgot it, used to talk about certain assets the way contractors talk about load-bearing walls. Not glamorous, not exciting, but structural. Trevor paid attention. For those same 3 years, he put the same $800 a month into a small mix of assets his grandfather had described. Gold-related holdings, long-term treasury bonds, a farmland real estate fund. No leverage, no complexity. Just a quiet allocation his grandfather swore by. His total contribution, also $28,800. and he opens his app. His balance reads $51,300. He's up $22,500. Let that land for a second. Same family, same savings habit, same starting date, same monthly amount. One brother is down $4,700. The other is up $22,500. The spread between them is $27,200, nearly a full year of Marcus's contributions, and it appeared in a single down year without either of them doing anything dramatic. Now here's the context that makes this even sharper. The S&P 500 finished 2022 down 18.1%, its worst annual performance since 2008. The traditional 60-40 portfolio, 60% stocks and 40% bonds, and which remains the default recommendation across most of the financial advisory industry, fell nearly 16% that same year. Both halves of the so-called balanced strategy lost money simultaneously. That is historically unusual. And when it happens, investors who built everything around a single market condition, growth, have no shelter. Marcus had no shelter. Trevor did. And here's what's worth sitting with. Trevor wasn't predicting anything. He didn't see 2022 coming. He wasn't making a tactical bet against the market. He had simply built a portfolio that didn't require growth to survive. That distinction matters enormously, because the difference between the two brothers wasn't one good year versus one bad year. It was the presence or absence, and of a second layer, a set of assets that behave by entirely different rules when the standard ones stop working. Marcus spent weeks after that Sunday trying to understand exactly why Trevor's holdings moved the way they did. What he found wasn't luck, and it wasn't instinct. It was a pattern, a repeatable sequence that shows up across every major market collapse in modern history, a sequence that explains not just who loses in a crash, but where that wealth actually goes. That pattern has a name, and it's called the crisis transfer theory. Most people think of a market crash the way they think of a flood: indiscriminate, destructive, something that damages everything in its path equally. That mental model feels intuitive. It also happens to be wrong. And that gap between what feels true and what actually happens is exactly where the money moves. When Marcus started pulling apart his brother's results, he wasn't just trying to figure out which assets Trevor owned. He was trying to understand something more fundamental. Why did some things hold value or gain it while nearly everything else was falling? The answer led him somewhere unexpected, not to a new investment strategy, to a different understanding of what a crash actually is. Here's the reframe. A market crash is not a destructive event. It's a transfer event. Wealth doesn't disappear during a crisis. It moves. It shifts, rapidly and systematically, from the people who didn't see it coming into the hands of the people who were already positioned for it. That's the crisis transfer theory in a single sentence. And once you see it that way, the history of every major market collapse starts to look completely different. The transfer happens in 3 phases, and they follow the same sequence every time. Phase 1 is the collapse. Asset prices fall sharply. Stocks drop. Real estate softens. Anything tied to the expectation of future growth starts getting repriced downward. Investors who are fully exposed to those assets watch their balances shrink, sometimes quickly, sometimes over months. Panic sets in, and panic almost universally produces the same response: selling. People liquidate positions to stop the bleeding, which drives prices down further, which triggers more selling. The collapse feeds itself. Phase 2 is the flight to safety. This is where the dynamic shifts. As prices are falling and panic is spreading, institutional investors, the large funds, the endowments, the professional money managers overseeing billions, don't freeze. They move. Capital exits the collapsing assets and flows, deliberately and at scale, into a specific set of alternatives, assets with different characteristics, things that hold value when growth stalls, things that benefit from fear rather than confidence. This isn't reactive. For the most prepared players, it's a plan they had before the crisis started. Phase 3 is the wealth transfer itself. And the people who moved into those safe havens during Phase 2 now hold assets that have appreciated, sometimes dramatically, while everything else was falling. That appreciation gives them purchasing power at exactly the moment when prices on everything else are at their lowest. They rotate back in. They buy the assets that panicked investors sold at the bottom, now at a fraction of their pre-crisis value. The transfer is complete. Now look at the historical record, and this sequence becomes impossible to ignore. During the Great Depression, the Dow Jones Industrial Average lost 89% of its value between 1929 and 1932. 89%. For most investors, that was generational wealth, simply gone. But certain gold mining stocks, companies whose revenues rose as gold prices climbed during the panic, gained 474% over that same period. The collapse didn't destroy that value. It relocated it. In 2008, the S&P 500 lost 57% peak to trough. Long-term treasury bonds returned roughly 25% over the same period. Farmland values held steady and, in many regions, continued to appreciate. While equity investors were absorbing losses measured in decades of savings, a smaller group of investors in different assets watched their balances climb. Even in the fast, sharp crash of early 2020, a 34% drop in 33 days, the fastest bear market in history, gold gained nearly 25% by the end of that year. The transfer was compressed into months rather than years, but the same mechanics applied. These aren't coincidences scattered across different eras. They're the same pattern, repeating. Collapse, flight, transfer, every time. And what Marcus realized, sitting with Trevor's account statement, was that his brother hadn't beaten the market. Trevor had simply owned the assets that sit on the receiving end of phase 3. The question is which assets those actually are, and why they behave so differently when everything else is falling apart. That's where the 4 crisis assets come in. There's a question worth sitting with before we go any further. If these assets have such a clear track record during downturns, why doesn't everyone own them? The answer isn't access. It isn't complexity. It's that these assets are genuinely boring when nothing is wrong. And most of what gets written about investing is written during bull markets, when boring things get ignored. But boring in calm conditions and boring in a crisis are two very different things. And the historical performance gap between these 4 assets and everything else, during the moments that matter most, is anything but boring. The first is gold miners, not gold itself, the companies that extract it. This distinction matters because of how the economics work. A gold mining company has relatively fixed operating costs. When gold prices rise, those costs stay flat, but revenue climbs. The profit margin expands fast. During the Great Depression, while the broader market was losing 89% of its value, certain gold mining stocks gained 474%. The reason is mechanical. As fear drives investors toward gold, the price of gold rises, and the earnings of mining companies rise faster than the price itself. In 2022, when the S&P 500 fell 18%, gold held its value almost exactly flat, while nearly every other major asset class declined. Not exciting in a good year, extremely useful in a bad one. The second is long-term treasury bonds. These are U.S. government debt instruments with maturities of 20 years or more, and they behave in a specific way during crises that makes them valuable. When fear peaks, like large institutional investors, the pension funds, the insurance companies, the sovereign wealth funds managing trillions of dollars, need somewhere safe to park capital fast. U.S. Treasuries are the default answer. That demand drives bond prices up and yields down. In 2008, while the S&P 500 lost 57%, long-term treasuries returned roughly 25%. They don't just hold value. They actively appreciate during the phase when equity investors are absorbing the worst of the damage. The mechanism is straightforward. Fear creates demand. Demand drives prices. And prices move in your favor. The third is farmland. This one tends to surprise people, and the logic is worth slowing down for. Farmland is a real, physical, finite asset that produces something the global economy cannot function without: food. And it doesn't get disrupted by technology. It doesn't reprice based on quarterly earnings expectations. In 2008, while financial assets were collapsing, U.S. farmland values were flat to positive. During the inflation surge of 2021 and 2022, farmland appreciated by over 20% in many regions. The reason is scarcity combined with inelastic demand. There is a fixed amount of productive agricultural land, and the demand for what it produces doesn't shrink during recessions. People still eat. That predictability is exactly what makes it defensive. The fourth is consumer staples. These are the companies selling products people buy, regardless of what the economy is doing: toothpaste, soap, canned food, basic household goods. The revenues of these companies are not cyclical. They don't depend on consumer confidence or discretionary spending. In 2008, while the broader market fell 57%, the consumer staples sector fell by roughly 15%. Still down? And it's worth being honest about that. But falling a quarter as much as the overall market, while still generating dividends, is a genuinely significant defensive outcome. It's not protection in the way a bond or gold miner might be. It's more like a shock absorber. The fall is cushioned enough that recovery is far less painful. What these four assets share is that they don't need optimism to function. Gold miners need fear. Treasuries need fear. Farmland needs hunger and scarcity. Consumer staples need a daily human habit. None of them needs a growing economy. That's not a coincidence. It's the defining characteristic of a crisis asset. It works precisely when confidence breaks down. Now, knowing that these assets exist and understanding why they work is only part of the equation. The more practical question is how much of your portfolio should actually hold them, and what a realistic, functional allocation actually looks like. That's the core of rethinking your portfolio strategy. Here's something that rarely gets said out loud in personal finance conversations. Knowing what to own is only half the problem. The other half is knowing how much, and almost nobody gets a straight answer on that part. Most people who consider themselves reasonably well diversified are holding some version of the same thing, a broad stock index fund, maybe a bond fund, perhaps a target date retirement fund that blends the two automatically. And on paper, that feels balanced. Two asset classes spread across hundreds of companies, different sectors, and different geographies. It looks diversified because it is diversified within one dimension, the dimension where everything still depends on the economy growing. Run the actual numbers, and this becomes concrete fast. A standard 60-40 portfolio, 60% in equities, and 40% in bonds, has been the default recommendation in American financial planning for decades. In 2022, that portfolio lost nearly 16%. The year before, it gained around 15%. So 2 years of gains wiped out in one down year. And that was a relatively moderate correction by historical standards. In 2008, a 60-40 portfolio lost close to 30%. In the Great Depression, the losses were effectively total for anyone without assets outside the standard model. The vulnerability isn't the specific funds you're holding. It's the zero in the third category. Crisis assets. Most standard portfolios don't hold any. Not a small amount. None. And that zero is not an oversight. It's a structural gap that opens wide exactly when everything else is falling. So what does a functional allocation actually look like? The adjustment is simpler than most people expect. You're not rebuilding the portfolio from scratch. You're not abandoning the growth engine. You're carving out a defined slice, somewhere between 10 and 20% of total holdings, and dedicating it to the four crisis asset categories. The remaining 80 to 90% stays oriented toward growth, the way it always was. The engine stays. You're adding a shield. Here's what that math looks like in practice. Take a portfolio worth $250,000. At a 15% crisis allocation, that's $37,500, moved into a mix of gold-related holdings, long-term treasuries, farmland exposure, and consumer staples. The remaining $212,500 continues compounding in broad equities and standard bonds. Now run both versions through 2022. The unprotected portfolio, fully exposed to the standard 60-40 model, loses roughly 16%. That's $40,000 gone on a $250,000 base. The adjusted portfolio, with 15% in crisis assets, absorbs a significantly smaller drawdown. The crisis allocation either holds flat or gains while the equity portion falls. The blended loss drops to somewhere in the range of 8 to 10% rather than 16. That's a difference of $15,000 to $20,000 preserved in a single bad year, without any change to the long-term growth orientation of the portfolio. And here's the part worth sitting with. That preserved capital doesn't just sit there. It becomes the purchasing power that lets you buy back into equities at lower prices during the recovery. The people who held defensive assets in 2009 weren't just protected from the 2008 losses. They were the ones buying S&P 500 index funds at $676 per unit when everyone else was selling. By 2013, those units were back above $1,500. The defense didn't just limit the damage, it funded the offense. This is not a strategy built on pessimism. It's not a bet against growth. or an argument that markets are broken. It's a straightforward acknowledgement that markets move in both directions, that down cycles are a permanent feature of the system, and that a portfolio designed only for one direction carries a specific and quantifiable vulnerability. Adding a crisis allocation is closer to buying insurance than it is to changing your investment philosophy. You keep everything that works in good times. You stop being completely exposed when good times end. Now, the obvious follow-up question is timing, not prediction. That's a different thing entirely. But there are signals that have historically preceded the most damaging downturns, signals that the largest institutional investors monitor closely. Knowing what those signals are and what they actually indicate is what separates reactive investing from genuinely informed positioning. Those signals are worth understanding, and they're closer to the surface than most people realize. There is a version of this conversation that goes sideways fast. Someone hears, "Watch for warning signs," and immediately starts trying to time the market, moving everything to cash at the first hint of trouble, then missing the recovery, then moving back in too late. That's not what this is. Timing the market is a losing game, and the data on that is unambiguous. But reading the market's vital signs is something different entirely, and the distinction matters. Think of it this way. A doctor cannot tell you exactly when a patient will have a heart attack, but they can read the indicators, blood pressure, cholesterol, arterial stress, and tell you with reasonable confidence whether the risk is elevated or not. That information doesn't replace treatment, it informs it. The same logic applies here. If these signals don't tell you when the crash is coming, they tell you whether the conditions for one are being built. That's enough to make a meaningful difference in how you're positioned. The first signal is the yield curve. This one has the longest track record of the three, and it's worth understanding properly rather than just knowing the label. Under normal conditions, longer-term government bonds pay higher interest rates than shorter-term ones. That makes intuitive sense. You're lending your money for longer, so you expect more compensation. When that relationship inverts, when short-term bonds start paying more than long-term ones, it signals something important. It means the bond market, which is dominated by some of the most sophisticated institutional investors in the world, is pricing an economic deterioration ahead. Every U.S. recession since 1955 has been preceded by a yield curve inversion. Not most of them. Everyone. But here's the part that gets overlooked. The inversion itself isn't the trigger. The danger signal is when the curve starts to uninvert, when it shifts back toward normal. Historically, that normalization phase is when recession risk peaks, and market damage tends to begin. The curve inverted sharply in 2022 and 2023. By late 2024, it had begun normalizing. Investors who understood that sequence were watching closely. The second signal is credit spreads. This one is less discussed, but equally reliable. A credit spread is simply the difference in interest rates between U.S. Treasury bonds and corporate bonds of equivalent maturity. Treasuries are considered risk-free. Corporate bonds carry default risk. In calm conditions, and that spread is relatively narrow. Companies can borrow cheaply because lenders feel confident. When credit spreads widen, it means lenders are getting nervous. They're demanding more compensation to take on corporate risk. That nervousness tends to precede actual defaults, layoffs, and broader economic slowdowns. In early 2020, credit spreads blew out within weeks, before the full economic impact of the pandemic became clear. In 2008, they started widening months before the headline crisis hit. When you see spreads moving sharply wider, something in the credit market has already changed, even if the equity market hasn't caught up yet. The third signal is unemployment, specifically the early movement off the cycle low. This one feels almost too simple, which is probably why it gets underestimated. When the unemployment rate has been falling for an extended period and then ticks upward, even slightly, even just 2 or 3/10 of a percentage point from its recent floor, it has historically indicated that the labor market has already turned. Not that it might turn, that it has. The hiring decisions that produced that uptick were made weeks or months earlier. By the time the number appears in the data, the slowdown is already in motion. In 2007, unemployment bottomed at 4.4% in May and began rising slowly. By the time most investors recognized it as a trend, the financial crisis was already underway. None of these signals works in isolation, and none of them is perfect. What they do, when read together, is give you a clearer picture of whether the environment is shifting from expansion to contraction. That picture, even an imperfect one, is meaningfully better than flying blind. Marcus understood, after working through all of this, that the signals aren't really about prediction. They're about honesty, honest accounting of what the data is saying, separate from what the headlines are saying, or what feels comfortable to believe. And that honesty points to something larger, the most important reframe of this entire conversation, the idea that changes how you think about every investment decision going forward. Because the market isn't one game, it's two. And knowing how to play both is the difference between surviving a downturn and being the one who cleans up after it. Here's what this all comes down to. Markets do not move in one direction forever. They never have. And every major downturn in modern history has followed the same sequence: collapse, flight, transfer. The people on the wrong side of that transfer weren't careless. They were just playing one game when two were being played simultaneously. The principles worth holding on to are straightforward. Diversification that lives entirely within one market condition is not real diversification. Wealth doesn't disappear in a crisis, it relocates. A 15% allocation to defensive assets doesn't sacrifice long-term growth, it funds the recovery. And the signals that precede major downturns are readable if you know what to look for. Look at your own portfolio right now, not at the returns, at the structure. Ask yourself what happens to it if the S&P 500 falls by 30% tomorrow. Where does it go? What holds? What doesn't? That single question will tell you more about your actual risk exposure than any annual statement. The two-game framework doesn't end here, because once you understand how wealth transfers during a crash, the natural next question is who orchestrates that transfer, and whether the system is designed to make it inevitable. That question goes deeper than most people expect. If this reframes how you think about market downturns, share it with someone whose portfolio is built for only one game. And if you want to keep pulling on this thread, subscribe, because that next question is exactly where we're going.